the VIX behavior in bull and bear markets. We're going to take a look and see what the VIX does. The VIX has this inverse relationship to whatever happens in
market,
the S&Ps, and we're going to see and take a look and see how that kind of plays out over time. So on average, the VIX has a very strong negative correlation with the S&P 500. But we also know that in market downturns, the magnitude of the moves in the market and the VIX increase. So what is the difference in magnitudes of moves in different market environments, and what can traders do with this info? Because sometimes it works and sometimes it don't. Okay? Most of the time it does, but how much of the time doesn't it actually work? And how confusing is that? And all that kind of stuff. We're going to take a look at everything today. So we looked at the last 5 years because I think for the VIX and the S&Ps, 5 years is a little more relevant. And we computed the average and standard
deviation. The further out you go in time, the less relevant it is.
Yeah. I mean, the last 5 years, we've had plenty of moves. We've had a pandemic. We've had crazy, record highs. It feels like every year. We've had one sell-off in 2022. So we computed the average and the standard deviation of average VIX moves during SPY up days and down days, and we did it separately. And then we computed the conditional probabilities of the VIX and the SPY movements. We're going to see some fun little stats here. So the average move magnitude in the VIX is 45% more when the SPY is down, and it has a 75% higher variance of moves. So when the SPY is up, let's say today the SPY is up a little bit, the VIX tends to move less with a tighter range of moves. I don't think that would surprise anybody.
No.
When the market's up, the VIX moves less and it contracts. When it's down, the VIX has a greater magnitude of the move. So we'll take a look here. So any VIX move on any day, and we looked at up days and then SPY down days, which I think is pretty fair. 3.5% on up days and 5.1% on down days. That's the mean VIX move. And then the volatility of VIX moves is significantly higher on down days than up days. And on any day, it's plus or minus 8.5%. What's really interesting about this is it just explains why there's put skew in the index products. And it also explains why we spend so much time talking about, hey, when you have a beta weighted position, we like to keep a little bit of short delta because it protects against those, the volatility in the market on those down days. That's all it is. The market's more volatile on those down days. It gives you a little bit more protection. That's it. That's all it does. A little bit of short.
When you're following the market, right? Sometimes a lot of NASDAQ stocks that you trade, the volatility actually go up as the stock goes higher too. So you gotta be a little bit careful. Make sure you're in the product. I know we're talking about S&P right here.
Yeah, we're talking about S&P right now. Using conditional probabilities, we can expand on this concept and say that there's a 21% chance that when the market is up, the VIX is also up, and a 27% chance that when the market is down, the VIX is also down. This is what confuses people. Because how can the market be up when the VIX is up? And how can the VIX be up when the market's up? And how can the VIX be down when the market's down? So there are those times. This is what we call keeping people honest. Okay, this is what it does. It keeps you honest. Like, well, today's probably today's a tough one because it's market's basically
mixed. You got even the S&P and
market's
higher,
mixed, and
Russell.
the VIX is only down a couple pennies, and the market's up a little. But a minute ago it was down, so it's hard. It's kind of hard to say. But I just want to point this out because sometimes, like, we'll sit here and we'll go, "Why is the market down and the VIX is down?" Or "Why is the market up and the VIX is up?" Well, 21 and 27% of the time, that's going to happen. So let's just say 23, 24% of the time, just under 1/4 of the time, that's going to happen. So it's not that weird, is my point. So the probability that the VIX goes down when the market goes down is actually the same as the probability the VIX goes up when the market goes up. This is another reason why we like to be short a little delta to hedge against the down moves of the market. What I said before. Since the chance of a double whammy, VIX up and market up, is 21%, and the chance of both going in our favor is 27%. Our hedge will work the same amount if it doesn't, but it serves to reduce overall risk in the portfolio. It's a crazy way to look at how to keep and track your overall position, because all you're trying to do is take advantage of a very small mechanical edge with the VIX being down, chance of them both going in our favor, VIX down, market down, as opposed to VIX up, market up.
And what to expect too. Like, if the market goes lower and you have a position like this, and you make money having a little bit of long delta on it, it's because volatility contracted or expanded to fit your position. So, it's not always about the delta, it's also about the volatility.
Right. But what these guys are saying, researchers here, is that it's 21 versus 27%. So there's a little tiny bit of edge to maintaining a little bit of short delta. That's all it is. Because 27% of the time, as opposed to 21% of the time, it works to your favor.
I'll take whatever edge I can get.
Let's go to the next slide. So some of the takeaways. On average, when the market goes up, the VIX goes down, but with less magnitude than when the market moves down and the VIX moves up. I know there's a lot of offsetting stuff here. But since the probability of the VIX going down when the SPY goes down is larger than the probability of the VIX going up when the SPY goes up, our short delta hedge will work around the same amount of time as it doesn't. The difference is that we have to remember is that the market goes up more than it goes down. So you have way more.
53% of the time. Is that the number?
Well, no, it's higher than that now.
Well,
it's higher than
it's
that.
every day now.
Yeah.
I mean, but I'm just going over time.
Well, it's higher than that. For the last couple of years, it's been closer to like 60-40 or 58-42, whatever it is. But so that's what offsets it, because there's always something symmetrical that comes out. But anyway, that's why we maintain a little bit of short delta. That was always our thought process, and now you know why we kind of wrote the mechanics the way we built the mechanics the way we did them.
Would you skew it a little bit for stocks that don't have that have an inverse relationship to the market?